Picture this. You're sitting at work. Same job, same desk, same lunch. And somewhere across town, someone, your exact age, maybe even with a lower salary than yours, is quietly building $1 million. Not because they got lucky, not because they inherited anything, not because they work 3 jobs, because 5 years ago, they started putting $5 a day into the right place, and you didn't. Not because you're irresponsible, because nobody ever showed you that $5 a day was even worth doing. That's what this video is about. My name is Jack. If you're someone who thinks investing is only for people with serious money, make sure to hit the subscribe button and give this video a thumbs up, because by the end of this, you're going to see $5 completely differently. Let's start with the uncomfortable truth. Most people are waiting until they make more money, waiting until they feel ready, waiting until they fully understand the stock market. And meanwhile, the most powerful force in personal finance is running in the background for everyone except them. It's called compound growth, and it doesn't care how much you know. It only cares how early you start. Here's what most people don't realize. Time is the real investment. Money is just the tool. Let's look at the math, because the numbers here are almost hard to believe. $5 a day is $150 a month. That's it. Less than most people spend on coffee. Less than 1 dinner out per week. $150 a month invested consistently into a broad market index fund, something that tracks the overall stock market at the historical average return of roughly 10% per year. After 10 years, $30,727. After 20 years, $114,189. After 40 years, $948,612. Nearly $1 million from $5 a day. And here's the part that should genuinely stop you for a second. You contributed $72,000 of your own money over those 40 years. The other $876,000? That came from compound growth. That came from your money, making money, which then made more money, which kept making more money. You didn't earn that. Time earned that for you. Now you might be thinking, okay, Jack, but 40 years is forever. I don't want to wait 40 years. Totally fair. So let's talk about what happens when you don't start early. Imagine 2 people. Person A starts investing $150 a month at age 22. Person B waits until 32 and invests the same $150 a month. Both invest until age 62. Person A ends up with roughly $948,000. Person B ends up with roughly $339,000. Same monthly investment, same market returns. A $609,000 difference, just because person B waited 10 years. That's not a small gap. That's a completely different financial life. And the only variable was when they started. This is why people who understand compounding treat starting early like an emergency. Not someday. Not when things calm down. Now. But here's where most beginners get tripped up. They hear invest and immediately picture complicated things. Picking stocks, reading earnings reports, understanding financial statements, timing the market. And that fear of complexity is what keeps people on the sidelines for years. Here's the good news. You don't need any of that. The simplest investing strategy, the one that legendary investor Warren Buffett has recommended over and over again, is buying a low-cost index fund. An index fund is basically a basket of hundreds of companies at once. Instead of betting on one company doing well, you're betting on the entire economy doing well over time, which historically, it always has. You don't need to pick winners. You don't need to follow the news. You just need to buy consistently and leave it alone. Think of it like planting a tree. You don't dig it up every week to check the roots. You plant it, you water it consistently, and you leave it alone for a long time. The tree doesn't care about what's on the news, it just grows. Now let's talk about where to actually put this $5 a day, because the account matters. If you have a job that offers a 401k with employer matching, start there. Employer matching is the closest thing to free money that exists in personal finance. If your employer matches 3% of your salary and you're not contributing at least 3%, you are literally leaving free money on the table every single paycheck. If you don't have a 401k, open a Roth IRA. A Roth IRA lets your money grow completely tax-free. You contribute after-tax dollars, and when you withdraw in retirement, you pay 0 taxes on the growth. On that $876,000 in growth we talked about earlier, zero taxes. That's the kind of detail that changes everything. And if you're under 18 or just starting out, most major brokerage platforms like Fidelity, Schwab, or Vanguard let you open an account with no minimums and start with whatever you have. $5, $10, $20, it all counts. Now here's the psychological part. Because math alone doesn't change behavior, psychology does. The reason most people don't start isn't money, it's identity. They don't see themselves as investors. They see investing as something other people do. Wealthy people, financially sophisticated people, not them. But here's the shift. The moment you move $5 into an investment account, you become an investor. Not someday, right then. And identity drives behavior. Once you see yourself as an investor, even a small one, you start making slightly different decisions. You think twice before a random purchase. You start caring about your financial future in a way you didn't before. The $5 isn't just $5. It's proof that you're the kind of person who invests. Let's also address the one objection I know you're thinking. Jack, what if the market crashes right after I start? Valid concern. And the honest answer is, it might. Markets go up and down. Crashes happen. They've always happened. But here's what history shows us. Every single crash in stock market history has eventually recovered. Every single one. And long-term investors who stayed the course didn't just survive crashes. They benefited from them. Because when prices drop, your $150 buys more shares. More shares means bigger gains when the market recovers. Volatility isn't the enemy of the long-term investor. Quitting is. So, let's bring this all together. $5 a day is $150 a month. $150 a month into a low-cost index fund inside a Roth IRA or 401k, left alone for decades, can realistically grow to nearly $1 million. Not because of luck, not because of skill, because of time and consistency. The wealth gap in this country isn't mostly between people who earn a lot and people who earn a little. It's between people who start and people who wait. You don't need a raise. You don't need a windfall. You don't need to understand every detail before you begin. You just need to start. Because here's the truth. 5 years from now, you're going to wish you started today. Not next month. Not when things settle down. Today. If this video changed the way you think about $5, hit the subscribe button. And drop a comment below, are you going to start this week? Because the best investment you'll ever make is the one you actually make.